When I was 21, I was working for Bob Proctor, and I asked him, I was like, should I save money? And he said the same thing. No, absolutely not. Especially at your age. Don't save anything.
Hey guys, you love our reaction videos, so we've got another installment coming your way right now.
That's right. There's tons of financial information out there. Our team likes to go out to the interwebs, pull those things in, and have us react to them. So without further ado, here we go.
It's one Airbnb to retire. So I pay $700 a night for this Airbnb. As you can see, this is just an average setup. It's not anything fancy, but it's the location. If you take 700 times 30 days, that's $21,000 a month. This house probably goes for between $700 to $750,000. So when you go get a loan with a bank to buy a second home, don't tell them that it's going to be a rental, because if you tell them it's a rental, you have to put 20 to 25% down.
Lie to
so
them.
what you do is tell them that this is your secondary vacation house. So you
Fraud.
only require to put 10% down.
Whenever you borrow money, you should lie about it.
I think he's thinking, look, my mortgage payment on this is going to be between $4,000 to $6,000 a month. I'm going to have cash flow coming in of $21,000 through my fraudulent
Right, because I don't have to put any money down on it.
statements to the bank, and what could go wrong? But that's still rosy and very optimistic.
And so I don't know if I were going to build an entire wealth empire, I would try to build the entire thing off of one single Airbnb. Perhaps it's not quite that easy.
And I also wouldn't build my empire off of fraud.
I also would not lie on federal paperwork when I go to borrow money.
What is a person that has $236?
Invest it all in yourself. You're already broke. Don't hold on to $236.
When I was 21, I was working for Bob Proctor, and I asked him, I was like, should I save money? And he said the same thing. No, absolutely not. Especially at your age. Don't save anything. Because everybody was trying to tell me, like, oh, you should have a budget. And he's like, no, I still don't mess with budgets.
This is fascinating. Really?
That was the first time I heard it. The stress that saving at a young age causes versus putting that money to investing into yourself. Now it's like, once you have a project that you make $1 million, $500,000, or $250,000, whatever, then you can probably start to maneuver and think about that kind of stuff.
Well, I think it starts with a scratch-off ticket.
That's it. Once you have a project that makes you $250,000, then you start.
I would say if they weren't like professionally trained in boxing now, very punchable people in one table right there.
Hit them right
but
now,
I wouldn't want to be in the same room.
So
I need you to have my back.
It's ridiculous for someone to say that when you're young, you should not save. That's absolutely asinine. Because if you have $239, you would be amazed at what that could turn into for you. We have a koozie right there. It's what you drink your drinks out of that says $1 for a 21-year-old can turn into $88 by the time they retire at age 66. That's how powerful your dollars can be. So for somebody to say, oh, well, don't worry about saving when you're young, that is just foolishness. That is silly. That is ridiculous. That's horrible, horrible advice.
Well, we know wealth building requires several main ingredients and components. And the first thing I always tell people is understand deferred gratification, understand discipline. When they're telling you that has no component while you're young, essentially go live your best life. Don't worry about saving. Go land the 250 to 500,000. That might keep you tuned into their content because it's all aspirational, but it doesn't tell you how to build up to 250 to 500,000, because it doesn't all happen at once, unless maybe you have a scratch-off ticket or you win the lottery.
That's exactly right.
How can I make 10K as a teenager? That's easy. Drive around town and look for underperforming properties. Then what? Get it under contract and go on Craigslist. That's easy. What else? Find a real estate investor and sell it to them for $5,000. It's that easy. Do that twice and you just made $10,000.
Wait a minute. What?
Wait a minute. There's an arbitrage situation here that only teenagers. This must be like, you know how you can play, there's like a whistle that old people can't hear, but young people can?
Yeah, or dogs. Yep.
And so I think that they're basically saying, go drive around, find underperforming properties, and then you'll easily be able to sell them to unsophisticated real estate investors. People who do this for a living.
Who actually have the money.
You're going to be able to go convince them. Essentially, is she saying bird dog it? Is that what that is?
I think that's what it is, but what kind of how's a teenager going to be able to assess if a property is underperforming? Like, what teenager has the concept? Seasoned professionals can't accurately identify those on a regular basis.
How many phone calls a day do you think we get from people trying to solicit us?
100,000 of them.
So you wouldn't take the teenager calling up to say, hey, I've got the perfect property for your business.
Yeah, Jimmy, come see me after math class. We'll talk about it. Sounds genius.
Dave Ramsey's a freaking moron. But he's a genius for poor people who don't have discipline.
If you don't want to become wealthy, follow Dave Ramsey.
If you just want to save your money and die poor, and you have no self-discipline, be poor. Follow Dave Ramsey and be poor. And the reason I say that is he says pay cash for everything, don't have any debt, and that's what I grew up with. Like if you can pay off your house, can you imagine paying off your house and not having a mortgage payment? That's the stupidest thing you could ever do. Can you imagine paying cash for a car? How cool would it be to pay? No, that's terrible. It's a terrible financial decision.
We're in this society now where it seems like extremes rule
That's all
everything.
there is, yeah.
That's all that's on air. That's all that seems that works. But that's not the reality of life. I mean, I will say Dave is definitely on one side of, hey, let's get rid of all the debt as fast as possible. But then I would say they're on the other side, which is saying never pay off your debt. Take advantage of the low interest rates and go invest it and you'll have the best life ever. They're both on these different sides. I'm telling you, the answer is actually understanding how risk works, how growth of assets works, understanding the difference between building wealth and keeping wealth, because there's a balance there in the journey where it will change. In the beginning, yes, you should be aggressive. So that falls into what they're saying. Probably counter to what Dave is saying because he's focusing on the discipline versus the wealth building or debt payment versus wealth building. But then I think as you get older, it falls more on the Dave side of things, is that to keep your wealth, you better not owe a lot of people money. You better not be too far out on the risk spectrum. It's balanced in the middle, and neither one of them are right.
There are multiple paths to wealth, right? It's not just one path is the only way to get there. There are tons of folks out there that have done what Dave says, and they've ended up becoming wealthy. It matters, where are you trying to optimize, and do you care about optimizing? Some methods are more efficient and more effective than others, but that doesn't mean that one leads you into the poorhouse and one leads you into the big house. That is completely foolish talk. Exactly what you said. You have to understand how money works and when is the optimal time to focus on which side of the risk equation.
Let's say you have an 11-year-old daughter named Ava. You as the parent hired Ava in your business and you deducted her salary as a business expense. Ava does office work in social media marketing. She earns $7,500 a year. You as the parent invest 75% of that income into a compounding interest account. Let's just say earning about 9% annually. And you stop when Ava turned 18. Without investing another penny, when Ava turns 60, she will have just under $1.3 million.
This is a strategy y'all have heard me share. I have an 18-year-old daughter, and as soon as she entered the workforce, I started encouraging Roth IRA contributions. I did a dollar-for-dollar match to make that happen. I think it's actually a great strategy to get your children saving, investing, and I even want you to match it. But also make sure that they have the skin of understanding the behavioral aspect. I don't want you just throwing the money in there so that it's worth 1.2, 1.3 million, like he said, whereas I want you to actually encourage the behavior from the children. I like the thought of actually tying in the component of work plus saving and investing and the behavioral aspects. He's not wrong. I actually think his math is actually quite right on. It's just the fact that let's make sure that after they leave the nest, they actually have the skill set to build wealth outside of you forcing it upon them.
Yeah, it's really cool as a parent to make your child a millionaire. It's a whole lot cooler to teach your child how to make themselves a millionaire. I think that's a much more valuable lesson to pass along.
Essentially teaching your kids how to fish.
That's it.
Keep your beater car. It could save your ass during an IRS audit.
That's a peach.
When you take full write-offs on your business vehicles, Uncle Sam might not believe they're for business use only. And keeping a cheaper car for personal use only that you don't write off is the easiest way to prove them wrong when the IRS comes a knocking.
There's a lot of YouTube videos that say, hey, go form an LLC, go buy that aspirational fancy car. I mean, there's people buying Porsches, definitely Teslas, and other things, and they're deducting them. They're running them through these newly formed LLCs with this suspect structure that they have. I'm like, look, everything's deductible until you get caught. There's lots of celebrities and others that have been caught up in these type of things. When you deduct a car through a business, you have to describe how much of it is personal use, how much of it is business use, and that's how you figure out your proration of deductibility of it. So if you do have a personal car, he's absolutely actually right.
Right.
But I still would be a little nervous because here's the next question. Well, here's the next question to go ask. How many miles did you put on the beater last year? How many miles did you put on that business deductible car? And if you put 17 miles on the beater because that's how many miles you put on it from buying it and then driving it to your house and it's sat outside your house, and the other one has 99.9% of your mileage, it's going to be a little more suspect. So just pay attention to those things.
You don't want to tick off the IRS because they are the ones that have the guns. They can actually come take your stuff. So it's much better to stay on the right side.
This is how we went from 0 assets to $5 million in assets in our first 2 years in real estate.
When we first started, we didn't know anything about private lending. So we were actually using our own money, buying one property, refinancing, getting that money back, buying another property, which was really slow.
We got to the point where we maxed out how many loans we could have in our personal name, so we had to look for other alternatives.
That's when we figured out the private lending game, and we took off like a damn rocket. When we started using a private lender, it was the same process of buying, refinancing. The only difference is, instead of doing one house at a time and waiting to get our money back, now we're doing multiple houses at a time, refinancing, paying the private lender back.
They're asking a hard money lender, a guy, a person, an individual, say, hey, I want to go buy a bunch of rental properties. I want to go this whole bank thing. So, hey, you just loan me money. The bank has already decided they won't lend me any more money because I have too many outstanding loans. But will you lend me money so I can go buy some more speculative rental properties? I'm just going to keep stacking this house of cards as high as I can.
So was
instead
it
of going to the
him
official
or
means.
her that has the rich daddy, mama,
has to
uncle,
be.
coming from growing from humble beginnings?
Yep.
I have absolutely no one in private lending I could have gone to
Zero.
and said, hey, got this idea. I want to go buy a bunch of rental property.
And by the way, the bank has already told me I am maxed out. I can't buy any more. So will you just start loaning me money?
So based upon that, do you think they really are worth $5 million, or they have $5 million of properties that are just leveraged with debt to the hilt?
If you have $5 million of assets, but you have $6 million
That's true.
in debt, you have a negative net worth. You haven't actually gone
Good
anywhere.
point.
You have to be so careful when it comes to building wealth. There's a difference in actually being wealthy and trying to appear like you're wealthy when all you've really done is racked up debt to your eyeballs.
We have sort of
That's a creative
something
Luna.
called a Protocol Armageddon at the company. So Protocol Armageddon is that's a kill switch.
When was this recorded?
So whenever we feel like we're no longer in a position to be able to best serve the community, we pull the trigger and 24 hours we're gone. We burn all of our assets, we cut all of our ties, and it's nothing.
Surely he's talking theoretical, because anybody who knows, that was the head lunatic. And it has a whole different meaning now.
Are they actually called that? Is that
yes,
what they,
that's what they call
that's what they
themselves,
call themselves?
lunatics. Because it has essentially crashed to pretty much nothing. It was over $100 at one
Hold on,
point.
so you think that
and that was a
wasn't
stable coin.
You think that wasn't real? You think he was joking about having a kill switch? I think he was being legit right there. I think he was actually saying they've built this thing that whenever we determine that we can no longer serve our customer base, we've designed what do you call it? A protocol Armageddon, where we essentially click the big red button and it all just disappears. Could you imagine putting your money in something where a guy says, hey, don't worry, I'm going to take care of you. I got you. But if things start going south, I'm going to just hit the eject button and I'm out of here and this thing is over.
So it is a Ponzi scheme more than likely, because I think that, we've seen, it doesn't matter which decade you look at. I mean, think about the mortgage collapse. It was all black box type things where they were collateralizing all these mortgages, saying, hey, they're just as safe as treasuries and everything else because they're diversified and we have our own proprietary way that we're calculating these risks. And then it collapses and we're like, what happened? It's the same thing with these stable coins. They use just enough complexity to confuse you, spin your head, and then guess what? The institutions make the money, the retail investor gets completely left holding the bag. I mean, there's so many. When I researched this collapse of Luna, I found out that there's institutions that put like 1.7 million, cashed out 170 million. Who do you think that was on the backs of? It was on the backs of a lot of the retail investors. Be careful when something sounds too good to be true.
Should I rent or buy? This is on your FYP. You have this question. I'm here to help you. Somebody who was renting out an apartment during COVID and wanting to get a house, I came to the realization that getting a house would just be better for me in the long run. But it might not be the same for you, so listen up. If you're going to be living somewhere anywhere for 5 or plus years, consider purchasing whatever property you're living in. If you prefer to be more nomadic, consider renting. Now, often renting can be cheaper than purchasing a house or getting a mortgage because of the upfront costs. But if you can find a mortgage that's about the same, a little bit more maybe, and a little bit less in your rent, check it out. If you buy a home, it gives you the opportunity to build equity and get your money back. Whereas if you're renting, you can't really get that money back.
But you have flexibility, right? I don't disagree with anything she said. I think that was actually really well thought out and well reasoned. If you're going to be somewhere for a long time, buying can be better because you build equity. If you're going to be traveling or not be somewhere for a long one, renting, you might not build equity, but it's generally cost less and it gives you maximum flexibility. I kind of agree with everything she said.
I agree, but I will tell you there's this other component where institutional buying of houses that are squeezing the inventory. I'm just telling you.
I know where you're going.
And then interest rates are causing this to be much more expensive. She's spot on because it's easy to say, hey, if you're going to be in a place for 5 years, go buy a house right now. But is it the best time to buy a house when everybody's doing cash offers, they're waiving due diligence and other things that I would never tell anybody go buy a house with no due diligence because you might be buying a lemon. And I also think this is very much tied to geographic location as well. That whole location ties into this housing market as well.
But here's the good news. Maybe you are somewhere where you can get into a house. They're not waiving appraisals. The market hasn't run away from you. If you are a first-time home buyer, one of the great accommodations we afford you is rather than trying to come up with 20% down for that first down payment, if it's your first home, we give you some wiggle room because we agree with her. It does make sense to get on the equity train if it makes sense for you to get on an equity train. So it's okay if you can only put down 3 to 5% on your first home. If you can do that and you're still able to do due diligence, get an appraisal, keep your monthly housing costs within 25% of your income, I do think that buying can be a viable option for you.
Here are 3 evil secrets of the financial industry only kept for the wealthy.
Ooh.
The industry does not teach you about debt because they'd rather you be at war with debt, rather than leveraging it to multiply your wealth as the rich do. You can grow your own family bank and pass it down to future generations. That way, neither you or your family have to ever qualify for a loan. Number 3, mutual funds were not made to make money from the stock market. They were created to make money off charging you management fees and your trust in them. Why don't they want you to know? The unknown creates fear. Greatest way to control the masses.
There was a few things that were off here. First of all, she's completely off when she says mutual funds are not designed to make money off the stock market. They're made to enrich the people through fees. That might have been true in the 80s, but in 2022, if you're buying mutual funds, especially like index funds and other things and ETFs, you better not be paying high fees. I mean, because you're basically getting direct access to the financial markets without cost and overhead.
The other idea of building up this private family bank, whether it's through an insurance product or whatever, she does not understand that we know 80% of millionaires are first generation.
Yeah.
But even if you're part of that 80%, statistically right now, by the second generation, 70% of that wealth evaporates and 90% by the third generation. It is really hard to build long-term family banks where your ancestral lineage have to borrow money if the second and third generations are just blowing through it because they're never taught how money actually works.
Because there was a lot here on the sexiness of how the wealthy use debt. I mean, we're wealth managers. We work with high net worth families. And I can tell you, here's some facts I know. Wealthy people don't come to us with a lot of debt. Nope. They're not at war with debt. They're just disciplined. They pay for their things. The people who are using debt to build wealth, it's on the latter part of their wealth building process, meaning after they have cash reserves, after they have basic wealth and savings, then yes, you can get into commercial real estate and other things. We do commercial real estate, and one of the biggest commercial real estate people in our area said, boys, I hope if you're getting into this, you got the pockets to cover it when it gets ugly, because it will get ugly, and you just better make sure you can cover it during those times. That's what's important with understanding debt.
The simple matter is there are no shortcuts to wealth. There are folks who've gotten lucky. There are folks that have, quote unquote, won the lottery with a financial decision they made, but that is the outlier. That's not the norm. The true way to wealth is tried and true, consistent, sound decision making. It's the exact stuff we talk about on our show at moneyguy.com, on the Money Guy Show. If you are trying to figure out some get rich quick, if you're trying to go figure out how to do something that no one else has figured out, I worry that you are chasing something that does not exist and is not real. So you need to be so careful and be on your guard who you're letting into your mind, what advice you're following. Because just because someone has followers on TikTok or has a video go viral does not mean you should be following their advice.
Yeah, tie into the financial order of operations, all the resources we give away at moneyguy.com, and you too will be on your wealth journey.